Nothing collapses overnight. It never does. The calm capital historian invites you to step back and examine a slow-moving, but deeply familiar vulnerability in modern finance. It is not dramatic. It is not new, but it is quietly growing. In 2025, the International Monetary Fund issued a report with a carefully worded concern. Beneath the calm surface, the ground is shifting in several parts of the financial system, giving rise to vulnerabilities. Those words did not make front-page news, but for those familiar with the mechanics of credit and capital, they struck a quiet chord. The IMF was pointing to the growing exposure that traditional banks have to a loosely regulated world of lenders operating beyond the boundaries of the traditional banking system. These are known as non-bank financial institutions, NBFIs. The scale is significant. Banks in the United States and the United Kingdom now have approximately $4.5 trillion in exposure to hedge funds, private credit groups, and other non-bank lenders. This is not an abstract risk. This is a shift in where credit originates and how it circulates through the economy. To understand the concern, we must understand the structure. NBFIs are not banks. They do not take deposits. They are not subject to the same capital requirements or regulatory oversight. Yet, they perform many of the same functions. They lend money, manage risk, and invest in debt. And increasingly, they rely on funding from the traditional banking sector. In effect, banks provide financing to institutions that behave like banks, but without being bound by the same constraints. The result is a growing system of shadow credit, lightly regulated, highly leveraged, and tightly interconnected with the regulated financial core. History has seen echoes of this before. In the years leading to the financial crisis of 2008, structured investment vehicles, SIVs, and off-balance sheet entities extended credit in similar fashion. These vehicles were not well understood until stress revealed their fragility. The IMF's concern is rooted in the rising defaults within this shadow system. In early 2025, Tricolor, a subprime auto lender, declared bankruptcy. Not long after, First Brands Group, a company with substantial leveraged debt, also collapsed. In both cases, losses were transmitted to their banking partners. Fifth Third Bank alone reported a $200 million loss tied to Tricolor. These are early signs. They reflect a broader concern. That risk has been migrating into parts of the system with less scrutiny and less ability to absorb losses. Three dynamics stand out. First, the scale of exposure. The IMF reports that banks with non-bank financial exposures exceeding their own capital now account for more than 40% of total banking assets. That means a sizable portion of the banking system is now vulnerable to losses it may not be able to cover. Second, the mismatch in regulation. NBFIs can take on greater risk precisely because they are not subject to the same rules. While banks must meet capital adequacy requirements, maintain reserves, and adhere to strict lending standards, NBFIs are relatively free to pursue aggressive growth. Some argue this flexibility improves market efficiency, but it also concentrates risk in ways that only become visible under stress. Hedge funds, for example, have resisted calls for greater oversight by pointing out they do not benefit from deposit insurance. But the issue is not protection, it is connection. Their failure can still transmit losses to the regulated core. Third, and perhaps most important, are the incentives. When interest rates are low and capital is abundant, both banks and NBFIs are incentivized to chase yield. NBFIs generate high returns by lending to riskier borrowers. Banks, seeking a share of those returns, provide funding. As profits rise, scrutiny falls. Underwriting standards weaken. The IMF put it simply, in the search for yield, there has been a lack of care around underwriting standards. This dynamic is not new. The history of finance is shaped by cycles of innovation, expansion, and eventual correction. What matters is not the novelty of the instruments, but the recurrence of the pattern. Over time, as more capital flows through NBFIs, systemic fragility increases. When defaults begin to rise, redemption pressures build. Investors seek to withdraw funds, but the assets are often illiquid or impaired. Institutions are forced to sell. Losses compound. In 2025, central banks have begun to ease interest rates slightly, but the overall environment remains tighter than in the decade following the 2008 crisis. Borrowers accustomed to cheap credit are facing rising costs. Some cannot keep up, and when the cost of money rises, the weakest borrowers fall first. That is where NBFIs are most exposed. This is not the first time that the margins of the financial system have amplified instability. In the 1980s, the savings and loan crisis unfolded as institutions took advantage of regulatory gaps. In 2007, it was the rapid expansion of mortgage-backed securities and structured products. Today, it is private credit. The labels change. The mechanics remain. When money is cheap, incentives drive expansion. When conditions tighten, fragilities surface. One might ask why banks continue to fund this system. The answer is straightforward: returns. Private credit has delivered outsized profits in recent years. According to the Financial Times, banks are increasingly lending to private credit funds because these loans offer higher returns on equity than traditional lending. This is due in part to the lower capital requirements allowed by the structure of the collateral. In short, it is more profitable. And yet, the structure that delivers higher profits also increases the risk. If the economy slows further, if job growth stalls, if inflation persists, if consumers and businesses struggle, defaults will rise. And when defaults rise, banks will face losses. Investors will seek redemptions. Funds will be forced to sell. And the cycle of deleveraging will begin. This is not a forecast. It is a pattern, one that has played out in different forms across decades and geographies. In each case, the early signs were visible, but they were often dismissed because the profits were too strong and the momentum too compelling. The cycle also tends to bring forward another dynamic: regulatory hindsight. Often, when systems crack, attention shifts to how oversight failed, how incentives misaligned, and how fragility was overlooked. Committees are formed, reports are written, but rarely is the next cycle prevented. This raises a quiet but enduring truth. Financial regulation is reactive by nature. It follows events. It does not anticipate them. And as financial innovation continues, especially in private markets, the gap between regulation and activity widens. At the Calm Capital Historian, we reflect on these dynamics not to provoke fear, but to offer perspective. Financial systems are shaped by incentives. When those incentives align with short-term gains and long-term risk, the outcome is predictable, not in timing, but in form. The warning signs today are subtle, institutional, not emotional, measured, not dramatic. But for those who study cycles, they are familiar. Capital is flowing into shadow credit. Risk is being mispriced. And history suggests that stress will reveal the true extent of exposure. This is not new. This is not shocking. This is the quiet repetition of old lessons. Thank you for watching another reflection from the Calm Capital Historian.